I'm Doug McKenzie.
And I'm John Ward.
And we're the co-hosts of the ABCs of IBC podcast.
Come join us as we share our unique perspective on the infinite banking concept as the creator, Nelson Nash, intended.
Welcome back. Doug was really surprised to see me show up at his door today with shorts on. He's like, shorts?
I said, really?
And I was like, well, maybe I shouldn't have worn shorts.
Yeah.
But I'm not interested in leaving fall. And heading into winter.
And sadly, we typically record in my basement, and pretty soon it's going to be pretty cold down here, so I don't think you want to wear shorts.
I did wear a flannel shirt.
Yeah, I guess that counts.
Yeah, t-shirt and a flannel shirt. So what are we talking about today?
Well, today we're going to talk about a term that is mentioned a bit in Brian Bloom's books, which John and I both like, called collateral capacity. Mm. And we don't hear that thrown around a lot, but I think that it's a great concept. And so we're going to just dive into that a little bit. John, I think you've got your copy of the book open. So why don't you tell them what book this is, which one from Brian, and then kind of read off his definition.
Right. So just to reiterate, Brian Bloom wrote a 3-book series called The Confessions of a CPA, but he has varying subtitles. And the one I'm referring to today, the subtitle is the truth about life insurance. And he has a principle. He has numbers of principles throughout the book, and this one is collateral capacity defines how much of an unstructured loan a financial institution will extend to you. And so when you're using these policies, right, he's saying there are 3 things that can increase your capacity. The first is your deposits, which are your premium payments into the account, which builds up this collateral in cash value. And then the second is internal growth of the funds already in the account or in the policy.
So paid up additions.
Yep. Yeah, and just the natural...
The guaranteed growth.
Yeah, the guaranteed growth, and then hopefully dividend growth and all that. And then the third way of increasing this collateral capacity is lien reduction, which is basically when you have an outstanding loan with your insurance company, for every dollar that you put back through as payment to pay it off, that increases the capacity again. So this is where we talk about the fact that you're really recapturing the principal, right? We're saying reduce the interest, right? Because, hey, we're offsetting it with growth and dividend payouts and that type of thing. But literally, you want to be, capturing all this money again, because when you pay it back, you can borrow it again. You can use it. Again, cash flow management.
Hence the infinite aspect.
Yeah. It's like reusing that money infinitely, which literally can be your lifetime and generations down the road. Literally using some of the same dollars that you used in your lifetime. They don't even know, didn't know you, heard of you, but because you started this infinite banking policy and this generational wealth tool.
Yep.
And that's why they've heard of you. But
down the line to where it wouldn't even be quantifiable to understand rate of return on that.
Yeah, that's true.
But that's one of the key tenets here of practicing infinite banking is that you want to establish and grow that collateral capacity. Yeah. And might as well just say it, because we always say it. If you haven't read the book, Becoming Your Own Banker, you should really read the book. Nelson will go into these different examples for financing, mainly pieces of equipment, some cars, things like that. And you'll notice that he never starts doing these things in year 1. Why is that?
Yeah, because he's trying to build up this capacity,
building
right?
his collateral capacity.
Yeah, and Nelson refers. It's kind of another way, I think, of saying your capital pool.
Absolutely.
which is your liquid capital pool, is your collateral capacity, right? Which your collateral is the collateral for the loan. When you're borrowing from the insurance company, they're using your cash value. In fact, they're using your death benefit as collateral.
Yep.
Right? So you got to have enough cash value. You can't borrow more than your cash value. You can't borrow up to your death benefit. But the fact is, that's collateral, so that if you have an outstanding loan and you pass away, if you got $1 million in life insurance and you got 100,000 outstanding in loans, well, then your heirs get 900,000, right? So, I mean, that's, yeah.
The collateral capacity is very unique with a whole life insurance policy too. It can be grown very easily, and it grows in real time. So, like John just talked about, the most powerful way to grow the collateral capacity is to make premium payments.
Yeah.
Well, I should say, if you have basically your entire cash value loaned out, it's pretty powerful if you pay that back too.
Yeah.
But in general, most people don't have that going on, especially early on. So, there's a certain amount of patience that's required here. This isn't an instant thing. We have a lot of people that will reach out and they're like, "Hey, I want to pay up a policy immediately and then take all the money out and do all this stuff." And it's like, okay, this is something where we're talking about building this collateral capacity for a period of years, really, and ideally decades. And you get to the point where a lot of our clients have multiple policies on themselves, on their kids, grandkids, and this collateral capacity might have grown from a few tens of thousands of dollars to hundreds of thousands, if not millions of dollars. And it completely opens up the world of possibilities for those individuals and those families. And that collateral capacity is instantly tied to what's available. It's very different than, we've talked about this before. I have a home equity line of credit. They valued my home for that very differently than what I could sell it for on the market. Like, just not even close, right? So there's over $100,000 that's not in there. If I have a business, a bank is not going to collateralize 100% of the business. But an insurance company collateralizes close to 100% of your cash value. So you have almost that entire amount accessible at any point.
Mm-hmm. Yeah, and I think that this idea that we think that we're going to have to wait years, right? We can build the collateral capacity, and we can be using it all along.
Exactly.
Because we're already doing, like, while we're putting away, well, let's just compare it to putting away into a qualified plan like a 401k. You're also buying cars throughout that time frame as you're building your retirement savings. You're doing mortgages. You're doing all that. Well, while you're building this collateral capacity in a whole life policy, you can be leveraging it at the same time to be doing those same types of things, whether it be cars, weddings, whatever.
John and I do
education. Yeah, exactly. Yep. That's how we live it. And at the same time, because we keep, as he says, keep putting money in or depositing, which are premiums, really. They're, but that is, in essence, just a building of this collateral capacity. Mm-hmm. And we always want this idea that we have a chance to leverage it, but that it grows uninterrupted at the same time, right? Because we're not actually borrowing our money, right? And, so that, and I'll speak to our clients, right? They have a portal, a policyholder portal that they can go into, and they can look. And one of the ways that if I haven't shared it with all my clients, I certainly hope today you'll get it, is that especially when you're first starting, you'll see even in the early days, you're going to have what they call loan availability. You're going to see a number. And, you don't have to go take a loan, but every day just go in there and look at the difference from the day before. It has actually grown. You haven't done anything. You've already paid your premium for the year, for example, or the month. And that thing just keeps growing. And that is the capacity growing every day. And then, of course, when you're adding to it, right? But then if you borrow, well, that collateral availability is smaller, right? But your cash value is still growing. I mean, you don't necessarily see that on the portal, but know that it is. It definitely is, because you'll see it in your annual statement, that's for sure. And so that's the beauty, is that you're leveraging this and you keep leveraging it and leveraging it and leveraging it over and over and over, because and you can do more because you have more.
Yep.
Right?
Yeah, it is a very unique thing to where that collateral capacity grows as you can use it. Again, to go back to this example, my home equity line of credit, if I go take out a loan and then I pay it back, my collateral capacity is quite literally exactly the same as it was before. I think the term on this one is maybe 15 years or something like that.
Yeah, that's
and
what
from
mine
start
was.
to end, it's going to be exactly the same. It's not going to grow. It's my collateral capacity stays exactly the same. But I mean, this is really the goal of practicing infinite banking is to grow that, is to grow the cash value, to grow the pool, to grow that collateral, to take advantages of opportunities in life, and to become more free.
Yeah. Yeah, I mean, that's interesting point with the home equity is...
Because, I mean, that the value of my house has ostensibly grown during that time.
Well, that's what I'm saying.
Yep.
What I was going to say was that for you to be able to get that collateral through your equity line, you'd have to apply, right?
Yeah, I'd have to cancel that line of equity and apply again and pay fees.
Pay fees and be beholden to whether they will do it or they won't, depending on what the economy's
I mean, not to
is.
mention they can yank that at any point, and my insurance company can never tell me I can't take a loan.
No.
So it's unrestricted collateral capacity is really what it is, you know?
Yeah, exactly. I mean, gosh, I think I'm going to get another policy. So
I know.
about that.
I know a guy.
Do you?
Yeah.
Okay. You trust him? Yeah. Wow. I think it's a short story because it covers a lot of what we've covered in the past, but just saying it in a different way. We're really trying to just help you wrap your head around it, right? It's a different concept.
Yeah. And it's a privilege to be able to take loans like this. I mean, it really is. It's people don't really think about it that way. People prefer sometimes the concept that they're going to borrow their own money. You don't want to borrow your own money.
No.
That idea, that misconception gets thrown out a lot. I hear it all the time on social media and YouTube. No, you're not borrowing your own money, and you don't want to be borrowing your own money.
Yeah. Because you don't want to interrupt
You want your money sitting there doing exactly what John talked about so that you can go do the things that you need to do in life and grow that collateral capacity.
And forever growing.
Forever.
It forever grows, right? Yeah. It's never going to diminish.
Well, until you hit 121. So if you live to be at 121, they're going to send you a really big fat check.
Then you don't have a life insurance policy anymore.
You're 121, you probably don't care very much at that point.
Yeah. I mean, and now, maybe you've already distributed the money, right? Because you've taken it out in cost basis, you've taken it out in loans, maybe to live on, but also to just give away, right? You could literally give it away, and now you don't have this big pile of money. You don't need this big pile of money. You want to give it to your benefactors, your heirs, while you're alive. I mean, and see them enjoy it, right?
We might have some clients, while people are living longer, who knows? We might have some clients listening that'll live to be 121. I know I'm going to live to be 121. So.
Well, they jumped it from 100. All these policies just 4 or 5 years ago went to 100.
Yeah, because way too many people were living to 100.
Yeah. So they they didn't just jump to 108. And they jumped from 100 to 121. So they know that the body.
The instance of centurions is increasing quite a bit.
Yeah, we know that the body can live that long. And
so you got twice as long more to go, John.
Oh gosh, yeah. Well, I feel pretty good, so maybe I can make it. Yeah, maybe I'll. Yeah, who knows?
the point is that the beautiful thing about these policies is that your capacity to do more with that, it just grows with time, especially once you get into adding more policies. It becomes this really exponential effect, and you get to the point decades in where you have the freedom to do things that you probably never thought you'd be able to do earlier in life.
Right.
So to our listeners, remember, this is a long-term game. That's what we're trying to kind of highlight here. This is not a get-rich-quick scheme. This is really about building long-term stable wealth.
Yeah. Well, I wanted to, what you just said there, I wanted to add this last little paragraph, sentence or whatever, that Brian Bloom wrote in this book, The Truth About Life Insurance, Confessions of a CPA, actually. He says, now, once you've made all the contributions that the account will hold, once it's growing at its maximum potential, and once you have no liens, your next alternative is to get a larger account. So, as Nelson referred to it, as like, if a bank is successful, then they open up another branch, right? And that's what, going off and getting a policy on another one on yourself or a spouse or children, right? Because you're looking for all the insurable interest places that you could put the money. Because you really now get the concept. Like, I maxed that one out. I gotta go and get another one somewhere and start maxing that one out. It's all good, right?
It's all good.
Yeah. And I don't want, I think people, I had this thought anyways, that, when I refer to Brian Bloom's books, The Confessions of a CPA, you do need, in a lot of cases, the subtitles, but they're all written about life insurance, and he's an advocate of whole life insurance, right? If you read just the main title, you'd think, well, this is something about taxes only, right? He's a CPA, right? No, he learned about the tax code, and he says you might not need life insurance. You might, in your own head, say, I don't need life insurance. But he says you're probably going to want the tax benefits of life insurance. Yeah. So that's like paraphrasing what he says, but anyways.
Yeah, I'm a big fan of his books. I mean, I think if anyone listening out there, I'd recommend getting them. They're really easy to read, and he breaks things down in a way that I haven't really seen anyone else do.
Yeah.
So I'd recommend picking them up. So
hey, I'm going to throw out an offer here, and if you've listened to the end of this, if you are interested, reach out to me or Doug.
Yeah.
And I'll and share your mailing address. If we hear from 5 people over the next week, 10 people, I'll send you a new book that Brian wrote called Twisted Confessions, and it's a fictional murder mystery story. And he finds a cute way of really talking about this whole concept within the midst of this murder mystery. It's really, it's pretty well done. It was his first attempt at fiction.
I haven't read that one yet.
And if the first 5 people that reach out to us, I'll get us your address and I'll send you the book.
Nice.
It's rather than just sit there and talking about numbers. Maybe one or both of you, a husband and wife, for example, like fiction better than you like nonfiction. So it's kind of a fun one, and I'd love your feedback if you go with it. So let us know.
Nice, man.
Okay,
that sounds good.
Yeah.
Until next time.
Till next week.
That's right.
All right. Enjoy your week, everyone.
Yes.
Thanks for listening
Enjoy your
again.
weekend. Yeah.
Okay. Bye-bye.
Thank you for joining us for another episode of the ABCs of IBC.
If you enjoyed listening, please hit subscribe and leave us a 5-star review wherever you listen. It really helps. See you next week.
Bye.